Hey everyone, welcome to this new video on support and resistance. In this video, we're going to break down this concept and go over some strategies to help you trade profitably in the markets. First, we'll dive into supply and demand zones. Then, we'll cover the range trading strategy, followed by the basing strategy. And finally, we'll wrap things up with a quick review. Let's get started with supply and demand zone. A support is a zone where the price has a strong potential to reverse. This means that demand is higher than supply, causing the price to rise. It's also known as a demand zone. Let's analyze Ethereum today. We have a strong support zone just here. This zone means that demand is higher than supply, causing the price to rise. As we can see, there's one rebound here, a second rebound here, and a third rebound here. We can expect another potential rebound at this level. There are also smaller support levels, like this one and this one. If I zoom in on a lower time frame, we can see that this level has been tested multiple times, here, here, and here. And in this zone, we can also see that this level has been tested 3 times, here, here, and here. A resistance zone, on the other hand, is an area where the price also has a strong potential to reverse. But in this case, supply is higher than demand, pushing the price down. This is called a supply zone. For example, we can see that there is a strong resistance level here. In this area, supply is higher than demand, which leads to a drop in price. We can see the first rebound here, a second one here, and 2 more rebounds over here. If we take a closer look, we can spot additional resistance level, right here, and here, for example. So, let's zoom in on a lower time frame to get a better view. In fact, we can see that this resistance level has caused multiple bounces, as on these 5 candles. And in this case, there were 2 strong rebounds before the price breaks resistance and rises. One key thing to understand is that markets have memory. Traders and investors create this memory through their actions. For example, break-even points and past support resistance levels influence their decisions. People who notice this support and resistance are the cause. An important rule: if a resistance level is broken, it becomes into support, and vice versa. Let's analyze this concept on TradingView. For example, we can see that there was a support level here. The price bounced off this level multiple times, here, here, and here, before finally breaking below it and moving down. But if we look at what happened afterward, we can see that the price came back up, tested this same level. In fact, there is rebounds here, here, and then a breakout to move upwards. This shows that the previous support level turned into a resistance level. If we extend this level further, we can see that it aligns perfectly with the previous resistance level we had marked earlier. These 2 resistances are in fact the same. This confirms that the market has memory, as past levels continue to influence price movements. Now, let's go over the range trading strategy and how to trade a range like a pro. First, you need to know that a sideways trend, that is, the price is stuck between support and resistance, dominates about 2/3 of the time. This means that most of the time, the price is stuck between a resistance level and a support level, as shown in this example. That's why it's crucial to develop a strategy based on this market condition. Here's how you can set up a trade in a bullish range. First, we have to analyze the trend. The price must be moving within a defined range, and the 20-period moving average should be flat. About entry criteria, the price must have bounced off both support and resistance at least once. There must be a new price rejection at support. We have to wait for confirmation candle, such as a doji, hammer, engulfing candle, or another reversal pattern to ensure the price is likely to bounce. The ADX is an important indicator to confirm a ranging market. If ADX is below 25, it suggests that the price is definitely in a range. The trade is triggered when the high of the confirmation candle is broken. About position management, We set our stop loss just below the support level. We move the stop loss to break even once we reach a 1-to-1 risk-reward ratio. And we set take profit just below the resistance level, around 90% of the range, to prevent premature reversal. By following this structured approach, you can improve your consistency when trading ranging markets. We have the same setup for bearish range. Alright, let's analyze this strategy on Bitcoin. We can see that there is a clear resistance level here, and a clear support level below. In fact, the price has tested this support multiple times, as well as resistance, twice. Additionally, the 20-period moving average is relatively flat, indicating no upward or downward trend. Let's see what happens next. The price rises slightly, touches the resistance level, and then forms a doji, that is a rejection candle, confirming the resistance. Let's check the ADX, Average Directional Index. It's at 16, which is below 25. This confirms that the market is ranging rather than trending. A short position can be opened when the price breaks the low of the confirmation candle. Stop loss is placed just above the resistance, and take profit is set just above the support level to avoid premature rebounds. The trade is triggered here, and initially, the price moves against us slightly. However, the price then reverses in our favor and hits our take profit level successfully. Let's analyze our second strategy, called the basing strategy. This strategy is designed to trade breakouts from a range, but there's one crucial rule. The breakout must align with the initial trend. For example, in this picture, the market was in a downtrend before entering a sideways phase. The breakout should occur below the support level, leading to a continuation of the initial trend. Now, let's take a look at how to set up this trade. First, we need to analyze the trend. A clear initial uptrend must be present, and the price is above the 50-period moving average, which confirms the bullish momentum. Regarding the trade setup, the sideways trend should last for at least 10 candles, ensuring a proper consolidation phase. Support and resistance levels or triangle formations indicate that the price is currently ranging. It begins to have upward pressure from 20-period moving average. We must set a minimum risk-to-reward ratio of 2-to-1. Before entering a trade, the price must have tested support or resistance at least once. The trigger occurs when the price breaks above the high pivot of the base, and we can use an additional indicator, such as the CCI, to confirm the upward momentum. For position management, the initial stop loss is placed below the recent swing low of the base. The stop is moved to break-even once a 1-to-1 risk-reward ratio is reached, and we can use a trailing stop below parabolic CR if CCI confirmed, for example. It means that if the CCI is above 100, this provides further confirmation that the price is gaining strength, and we can add a trail stop. We have the same setup for low-base strategy. Now, let's analyze this strategy on charts. Let's analyze Ethereum on the 1-hour time frame. We can see a downward trend forming, and the price is currently below the 50 SMA, which confirms a bearish trend. There's also a small support level here, and a small resistance level there, suggesting that the price is moving sideways within a range. Let's see what the price does next. We can see multiple rebounds off these levels, reinforcing the consolidation phase. There are more than 10 candles in the range, validating the sideways. Let's check the 20-period moving average. It's applying downward pressure on the price, confirming the bearish sentiment. Based on this, we can set up a short trade with a sell stop order placed here, a stop loss just above the last swing high, and a take profit at this level, ensuring a proper risk-to-reward ratio equal to 2. The trade is triggered here. So let's check the CCI. It's currently at -159, well below -100, which confirms strong bearish momentum. Then, to manage the trade, we can use a trailing stop based on the parabolic SAR. It's represented by these small markers. As long as the price stays below them, we remain in the trade. the price continues to drop here. And we can see that it's still below the parabolic SAR. It's making an impressive move here, and it continues to go down. Finally, the SAR indicator signals an exit as the marker moves below the price. Our trade plays out perfectly. Let's measure the move. We capture a 22% drop, which is a great result for this strategy. You have to know that if the CCI wasn't below -100, we'd be out at the initial take profit. Let's wrap up this class with a quick conclusion. First, support and resistance are key levels where price reversals are expected. A support level can turn into resistance, and vice versa. When trading a range, meaning a sideways market, the best approach is to use the range trading strategy, which focuses on price rebounds off support and resistance. On the other hand, if you're looking to trade breakouts, the basing strategy is more effective, as it allows you to capitalize on strong price movements once support or resistance is broken. Breakout moves can be much larger than range-bound moves, meaning this strategy has the potential for higher gains compared to range trading strategy. Okay guys, thanks a lot for joining me, and see you soon for the next lesson.